Welcome to the next chapter, brought to you by Contractor Academy. I'm Bill Kennard with Grandin Associates.
And I'm Glenn Herman with Creative Business Services.
Hey, how are you doing today, Glenn?
Well, we don't match. That's a good start.
We did last month.
I've had the flu and norovirus in the last couple of weeks, I think. I don't know what I've had here, but anyway, there are a few people that I do owe email or phone call back from last week, so I apologize. I will be getting a hold of you this week or early next week.
Cool.
So,
well, very good. I'm glad you're feeling better and back in shape. Well, I'm excited about this month's episode. Now, a couple of things as we do get rolling here. Again, we're going to Glenn has really got a whole bunch of the information today because it's really what you live and breathe, isn't it? Right?
It is. It's the first step.
And it's kind of that first piece of the puzzle. And so, usually for any of the Grandin clients who are part of this thing, when we get to this step, I'm kind of referring you over to Glenn and his team over there to help you out and kind of take over a little bit. Now, a few things just housekeeping-wise, if you will. We're going to, we've got the Q&A box up in front of us, and so we can see if you use the actual. There's two different options on your Zoom bar on the bottom. The first one is chat. We're not actually looking at the chat box here. We don't see that one in front of us. But if you use the Q&A box, any questions that you type in throughout the course, we've got that window in front of us. We will absolutely see those come in. We'll be able to answer those questions in real time. Now, if you're watching the live stream on Facebook or YouTube, unfortunately, we're not seeing those comments coming in, but certainly shoot them in. Even if you put them in as a comment there, we will check with them afterwards, and we will definitely get back to you on that one. So with that, that's kind of the direction that we are running. Now, again, if you've been one of the individuals, and we've gotten, again, several hundred each month that come through and watch this, if you've been a couple of those individuals that have been in many of them, you know that we've kind of been walking through a process and really the 10 steps, action steps that you need to take as you lead up to this business transition process. And so really these 10 steps, we've already covered a number of these in the past. And so this, again, this month we're dealing specifically with the business valuation is going to be our topic today. Now, if you've not been in the previous ones, we've got these 10 action steps. And we've also, in addition to the action steps, we've got a couple of timelines. In other words, at what point, what's the latest that you should be getting started to look at these items as we start digging into this transition process? And Glenn, we talked about that in the past as far as those really three different areas, right? So, there was really true succession planning. I need to find my successor. There's really transition planning. I already know who that is. It's one of my kids. It's an employee. It's somebody we already have secured. We just need to work on that process of the transition. And then there's exit strategy. And it's just getting out of the business. So with regards to today's topic, and for those who are looking at the 3-year and 5-year plans, again, we're going to share those in the chat box for you. So you actually have a copy of those action steps. We'll share those timelines. So with the valuation piece of the puzzle, does that really apply to all three of those? Right? I mean,
it does.
I'm selling it to my kids. Do I really need to get a formal valuation?
It does. We always say we don't want the flavor of the turkey to change at Thanksgiving.
Right, absolutely.
And, if you have a third-party valuation to say, here's the value, certainly it's going to be, it might not be the market value necessarily, but we can look at a financial value in terms of, here's what the market at a minimum would likely bear, to pay for this type of business.
Sure.
And I think that's important because you have clarity between buyer and seller, or parent and son, or parent and daughter, or whatever that might be, the case may be. And I think that's an important in the transition, so that everybody feels like they've been treated fairly.
Okay, yeah, right. Because as a seller, we always want the price to be as high as we possibly can get it, right? And as the buyer, we want it to be as low as we can to get it. Right. And somewhere, again, I still want Thanksgiving dinner to taste the same. So, that's where I agree. I think it's incredibly important to have that valuation. So again, with these timelines here, and we're not saying that. So the action steps that we're listing out in here, tie back into those 10 action steps that we had, on the first page of your handout. And again, that's in the chat box. You can click on it and download that. So we're not saying that this is when you start working on this item. We're saying this is the latest you need to get to it. It takes time to walk through this process.
I think even healthy businesses that aren't in a maturity phase of their business, I think in the growth phase, it's important to value your business.
I would
to
agree.
see where you are. It's a good barometer. It's going to bring out information that maybe you're not seeing. Seeing the forest through the trees kind of thing. It's gonna bring some things to light that are going to be encouraging, certainly. But it's going to also showcase unresolved opportunities and problems.
Oh, you mean those things are going to be depressing?
Well, a little bit. I mean, we look at. I never call it a problem. I say it's an
opportunity.
It's an opportunity,
right? And it really is. And that part of the puzzle is important for you, is because it's important for you to remember, because again, you're preparing your business. And so that piece of the puzzle is important to prepare it, right? How do we get it ready? And so we're going to talk about a lot of things today. As Glenn and I were preparing for this, we're looking at a lot of information. And last month we talked about the health of the business, and you're going to see where a lot of last month's stuff really applies to today, aren't we?
Yeah, absolutely.
Right. So we're going to share with you a couple of those ideas. And so again, that's the question all the time. What is my business worth? Right. There's things they can do to increase the value of their company as
Absolutely.
they prepare for this.
Absolutely, and there's strategies that you can take to make yourself more profitable and look better in the eyes of a potential buyer.
Absolutely. And so those are some of the things that we want to look at. Now, Glenn, I want to walk through a scenario that's very common because every time we do a succession planning program in person, that's one of the first questions I hear is, what's my business worth? Tell me how I can find out what the business is worth. In fact, I did one program. It was an 8-hour program, and in hour 2, they're going, forget all this stuff. Just tell me what my business is worth. Yeah. Well,
rules of thumb.
Rules of thumb, right? And so this is a process that certainly we have seen, we have used, and over the over the last couple of years, I share this, but then I say, okay, let me tell you some of the issues with it. Right, so you can go out to a lot of different websites and actually get fill out a form, right, and get a valuation. I can, give me my numbers, and it spits out what my company is worth. I can go to, an accountant sometimes and get the same basic information. And really, here's the process they use: is in effect, take the pre-tax net profit of the company, add to it, what the owner has taken out in terms of salary and anything else the company has taken, and then put a multiplier on that. Right. So if we were to walk through one of those examples, right? So as the owner of the company, right, maybe we're doing $750,000 in this company. As the owner, we had a 6% pre-tax net profit. That's $45,000. The owner had himself slated for $50,000 in wages. The company is making his truck payment and truck insurance, and we've got some other expenses, right? That tallies up, all those other things that are there, the health club dues that we haven't used in 2.5 years, but we're still paying for, and those things, right? That's another $23,000. And so very simply, it comes out to add together the profit, the owner's base salary, and then anything else the owner is coming up to. That comes out in this example of $118,000. And okay, then I take and put a multiplier on that, right? And so, I think the multiplier that's fairly common is 2.5, 2.8, somewhere around, in that range. So 2 to 3 multiplier. So that comes up with $296,000 in value. Now I'm going to add to it something for the equipment, and let me tell you, that 7-year-old Sawzall is not worth $4,000. Right? It seems like every time somebody wants to sell stuff, it's all gold-plated, right? And so we tally that up, and we come up, okay, boom. In this case, business is worth $400,000. Like it or dislike it?
Well, I don't particularly care for any rules of thumb methods with valuations. In terms of that approach, it's loosely. Most of these online, Facebook, forms that you fill out or website forms that you fill out, they're typically loosely based around the concept of what we would call an income approach, where we're looking at the financials. But as we've talked about over the last several months, that's not the only thing to consider in the value of a business. A couple of things that popped out in the discussion, owner salary. If we looked at an owner's salary of $50,000 per year, and I think we have a slide. If we look at that, and again, these are larger businesses, but if you took that officer's compensation of 260 and divided that by 4, you'd still be a little bit light in terms of
officers' compensation. You're right here on this line item.
Yep.
Right, when I come over to 2020, it's at $228,000. So first, before we get there, we got to explain where is this information coming from?
Well, this information is industry average information that comes out of one of the sources that we subscribe to as a valuation services portion of our business. This gives us industry averages. They're typically about a year and a half behind, which you'd expect because that data has to be tabulated. But it's very accurate. This is actually based on the M&A sales and the information that we've gathered.
And so, and as we go through here in a little bit, we're actually going to share this document with you, so you've got some of this information. But Glenn, define, how big of a company are we talking about in this data?
$3 to $4 million.
$3 to $4 million, right? So it kind of gives you that aspect, so you can, as Glenn was starting to say, use that as a guideline, right? So let's go back to that, if we can just see the larger copy of this thing one more time, right? So if I go back in there, and so this is, I just took the top portion of it, and so if we're looking at a company 2020 average of 3.6 million, right? And so then I come down and I see the officer's compensation, and I come across to 2020, and you can see the historical data there, $228,000. That's really everything they're taking out, right?
Correct.
Okay. So you were saying that if I'm in our example here.
In our example of a $750,000 company, roughly, let's take a quarter of that. You're already selling the value of your company short.
Sure.
The reality is, you're already taking less out of that company. Or how should I say this? Your multiple is based on 50,000, but the industry average for somebody would be over 60.
So if the company was a little bit more healthy, if we had really paid attention to some of our numbers and the business health, by the way, right? That number, you're already, what that's telling us is
Correct.
that you're behind the average company.
Correct. And then it begs the question, why is that the case? Well, we can look at things like cost of sales. What is the difference in the cost of sales between that particular company and their revenue? What's that ratio? And we look at it, that's going to give us a barometer of the health of the company, certainly, but it could be buying power, it could be geography, it could be distance in trucking from distribution, it could be any number of things that are affecting that.
It could be the price increases that we've all experienced over the last 2 years
Absolutely.
that, quite frankly, we haven't kept up with in terms of our street pricing.
Which is, again, it's so important to understand and monitor, manage, and own your financials. You have to be intimate with them on a daily, weekly, monthly basis to know, you have to do that job costing after every job to make sure that you're still in line. And if it's different, why? What's changed? You can offset some of the increase in costs by improving efficiencies, but at the end of the day, the net profit is the net profit.
That's exactly right. Yeah. And so again, and we'll actually, we're going to share with you some more of this industry information so you can see how you compare, because quite frankly, all of this goes into the valuation of the company.
It does. It does. Some other holes that I poke in that example, when we're looking at net profit of 6%, that's actually just slightly above the industry average. I mean, typically we see 3 to 5%.
Said here.
Yeah, and when we're talking about, that's one of the things that I love about your program, Bill, is you focus on the numbers. And when you focus on the numbers, I ran an HVAC company where we were double digits. I mean, we were on any given year between 11 and 15%. Right. That's a pretty profitable business. I'm working with a company right now here in the Midwest, and they're at 15 plus. So, it is possible. It's doable.
It's absolutely doable.
It's just a matter of managing it. So when we look at, the other things that I look at is that 2.5 times annual profit as a multiplier. That multiplier, when we base it off what we call seller's discretionary earnings, that's an oftentimes utilized multiple. It's usually done by people in my industry, business brokers who know how to read financials, but don't have their finger on the pulse of the market.
Okay.
They're selling every kind of business under the sun. They're not focusing on any niche, any specific niche, and with that comes, I guess, a little bit of a rules of thumb start to creep in.
The swag method kind of.
Yeah, right? And it's not as effective because that multiple that we're seeing, that 2 to 3 multiple of seller's discretionary earnings right now, I know is very light, especially geographically in our region. That's light.
Right, and so for those of you, we're in the upper Midwest here.
Correct.
Right, Wisconsin. So yeah, that would be light.
I mean, it's the same thing as down south. It's the same thing down south. It's the same thing out east. Labor is such a challenge right now, and I'm sure, regardless of where we're positioned right now, labor is always a constraint, a limitation. To the extent that that is managed well, can be a great effect on value of a company and can affect the multiple.
So when you say to the effect it's managed well, what do you mean by that?
If you have a good process for hiring and keeping employees, and keeping happy employees, and have a training program, and have a way to extend the value of each employee when they're meeting with your customers, when you have a plan that's in place, you have a service model, you have an expectation, you have a follow-up plan, all those things kind of are encompassing into the customer experience. We also hear those words thrown about. If there is that focus and you have those employees that are staying, there's a finite number of people in the trades.
Right.
And as much as we'd like to think, we're completely specialty, there still are people that are working their way into the trades, but the reality is not at a rate that's keeping up with the growth of the industry.
Or the rate at which people are leaving because of retiring or
absolutely, and we're seeing that in so many industries. And as being an HVAC contracting professional, is that the best? Is that the direction that kids are being pushed in school? I know in our area it's not. It's not the case. And there's some real initiatives to change that. But I'll tell you what, you can make a lot of money in the contracting world if you're knowledgeable, if you're certified. We talk about NATE certification. In a past life, when I was running an HVAC company, that was kind of the direction that we focused, and that was so many years ago already. But that credibility, that education, there's so much cost to put into a program. You really have to be doing it right, and you really have to maintain and keep those employees. It makes your business so much more valuable in so many ways.
It's interesting. So last week I had a conversation with a contractor. I was traveling for training, and I had a conversation with a contractor, and he said, "But Bill, I'm tired of spending money on training people.
Yeah.
I put money in, I make that investment, and then they leave and go someplace else."
Yeah. It's not uncommon.
How do you answer that?
Yeah, that's a difficult one. It's a cultural thing, though. People don't leave companies. People leave people.
Yeah, agreed.
And sometimes it's upper management that has maybe a micromanaging philosophy, or it could be any number of different things, or it could be a middle manager, or maybe that's just they can't get along with coworkers. That begs the question: did you do a good personality analysis on that person before you hired them? Well,
it's coming back to some of those same things we talked about in last episodes, right?
It is. Yeah.
So and then there's also that old adage, right, that says, okay, I can pay to train them and they leave. Well, okay, you can not train them and they can stay, right? So, I mean, which one do you really want to have on your team, right? So that becomes certainly an issue. What about any other holes that you saw on this piece of the puzzle?
Well, we look at, the other things, in addition to labor availability in a particular market, you really have to look outside of this income-based approach, or this multiple of earnings before interest and taxes, or EBITDA. Looking beyond that, what other type of goodwill is there? How long has the company been? And I'm not one to speak in terms of platitudes when we're talking about marketing, but there is something to be said for companies that have been a pillar of the community, that are very involved in the different aspects of giving in the community. Maybe they're involved in a church or a school, or they have a pet project that they do every year, and so there's some value over and above the financials. And that has those type of things. What kind of market share do they have? Are you the only game in town? Well, that kind of changes the calculus a little bit as well. And if you've been around for 25 years as well, by the way, maybe that changes things in terms of entry into the market by a competitor. And so that creates value. And those are all things that we have to consider. The market approach is one that we look at in terms of from a broker standpoint. I look at it in terms of the immediate market area and my potential universe of people that would buy the business. A valuation specialist isn't going to necessarily look at it in those terms. They're going to just look at it in terms of value. What have like-kinded businesses sold for in this particular market? And maybe we can, make an argument for service-oriented businesses. What have those sold for in a market if we're a service-oriented business? If we're wholesaling, or if we have a component of our business that does something outside of the purview of somebody typical in our industry, those things have to be considered.
So even the aspect of if I and again I'm going to use an HVAC example again, or a contractor, is that if I do installations, I don't like to deal with service. Service is a pain in the rear, right? So I'm not going to deal with service. All I do is installation.
Sure.
That impacts the company, doesn't it?
And not necessarily favorably.
Right.
It can be actually detrimental because you haven't really. You're always going to have to do some service. If you're doing installs, you have to service what you install in most cases. Some people don't.
You're right. Some people don't. My question is always, well, then who is servicing it?
Right.
Right. Because you're literally giving those customers over to somebody else at that point.
And in terms of looking at it just from a purely business standpoint, outside of valuation, you're stagnating your lifetime client value.
Right.
And that's the worst thing you can do in business. You always want to expand that to the extent that it's profitable.
Right.
So you could potentially limit yourself in value in that regard. If you are, I'm a service company, or I only do refrig, or I only do rooftop, I only do rooftop commercial, or I only do this or that, or I don't do new construction, or I don't do new building. Those kind of situations. Certainly, you're going to gravitate to what you're best at, and if residential replacement is your bread and butter, and that's what you love doing, then you're probably going to gravitate toward that. But it's very difficult to segment a business as well, and that's what buyers are looking for as well.
Right.
In the contracting world. Is this what's the segmentation? I get asked from companies that are doing roll-ups meaning they're buying a bunch of companies to gain market share. We look at those particular situations and we find that they're looking for somebody with a diverse background, but by percentage they're looking for something like, one buyer is looking for, that I'm working for, is looking for somebody that's largely residential replacement and 80-20 residential commercial. And they're also looking in a different area, looking for the exact opposite, 80-20 commercial to residential.
Kind of that market. So I'm curious, it kind of ties in with this thing, right? So we just had a question that came in. How do you account for the last 2 years? Right? I mean, this last 2 years has been a real anomaly, hasn't it?
It has.
And so still have the business, it's going strong, right? But due to COVID sales and profits, right? Okay, wait. But due to the COVID sales and profits have dropped about a third. Okay, so again, there was that massive spike, and now it's starting to go down.
Right.
Actually, then you factor in the cost of inflation that's starting to hit us at this point.
Correct. How do you account for that? Well, certainly buyers understand that there's an anomalous situation there. So everybody's been part of COVID, so everybody's understanding of what the situations were. We've done a couple of things, depending on where you fell in that COVID, where the break was, and we could kind of segment that portion of the financials out, and have understanding of it. I like to do trailing 12s. Like when I was doing valuations a year ago, we were looking at trailing 12s to capture some of that, but to show what we had in totality over the last 12 months. And then moving forward, we did that. Now that we had year-end 2020 and 2021, a little bit different flavor. Certainly the PPP money that a lot of people had too. That's a consideration. What did you do with it? Did you account for it separately? What was it used for? All those things have to be considered as well in the financials. But insofar as the financial numbers, you deal with it by looking at it, and that's where your multiple can be affected. But interestingly, things that might be, if I'm selling a business in the HVAC space or any contractor space for that matter, I'm looking at that and I'm saying, okay, how many new customers did you acquire? And what was the cost of acquisition for those customers? What was your cost of goods sold or your cost of sales? Because your cost of sales may have gone down.
Sure.
Because maybe you had people working from home more. They weren't going and doing in-person quotes. Maybe they were doing them. I had a furnace that they weren't. The contractor said, "Well," I said, "I want to get a quote on a furnace because I'm working at home. I'm thinking this is my inner sanctum. This is my home office."
Right.
And everybody was remodeling. If you're a remodeling contractor, I mean, you were knocking the cover off the ball the last year and a half. And when we looked at, that was a difficult. By the way, it was very difficult to sell those type of businesses because they were all doing so well. Some HVAC contractors in the last year and a half have done very well. I wouldn't say that, and not to discount the last person's situation. It's so different depending on where you were located.
So really, again, some of those other things that you brought up. So revenues were up, right? What did you do? Did you get PPP funds? What did you do with them? How did you do them? Every one of those situations is a little bit unique, isn't it?
You want to have an explanation in those situations, but understand that buyers and just the public in general, everybody's pretty aware what we went through as a country and economically. And so any favorable spin that you can put on what you did, and let's face it, I mean, it was tough. It was tough for all of us. Even in our industry, we saw a quarter that was crickets. I mean, it was everybody was just, I'm not spending any money and I'm not selling my business because I have to survive here.
Sure.
It's not worth anything. Nobody wants to buy, the mentalities were really shifted and changed. So we have to just be considerate of all those things.
And I have to think also that, so some of the questions are a whole bunch of companies, let's word it this way, right? They saw a massive increase in revenues, right? Because they were running silly as well.
Sure.
Right? And then, now that's starting to come down, just like the question that had, we lost about a third of that. I have to think one of the things that would be somewhat visited is, did it come down back to pre-pandemic levels, or did we actually retain some of that?
Well, and that's definitely something that a buyer is going to look at. And when we're looking at numbers in general, profit per sale, if we're breaking it down in terms of ratios, net profit, and I think we have that slide in here as well, where we talk about what ratios should we be looking at in terms of the health of our business.
Right.
There's things that we certainly look at. Things that I look at the first, peek I get at something. I'm looking at a lot.
And that is what, right? So before the program, one of the things Glenn said, right, because there's a whole bunch of analytics that we've got in here. One of the things you said to me is, well, we could be getting in the weeds here, but because usually if there's a problem, you're going to see it in a lot of other areas, right?
Right.
And if we need to, then we'll go and look a little bit deeper. So one of the other questions that comes in, and I don't know, I don't think we're getting ahead here, but the question is, how do retained earnings factor into the valuation?
Sure, and retained earnings that's what we typically see on the balance sheet. The balance sheet, as we all know, that's a snapshot in time that says, here's where things are at. Whereas when we look at like a profit and loss, it's kind of more like a video. It gives us the picture over the course of the month. The retained earnings, how does that work into a valuation? We pull those out when we leave. When we exit, we typically take that out. Depending on the size of the company, any cash that's left in the business is going to come home that's going to go with the seller. Now, that being said, if depending on the size, there might be a need for operating capital, in which case some of those retained earnings might be utilized for keeping the business afloat until additional receivables come in and things of that nature. And that's typically what I found. You're going to be north of 5 million. I mean, usually in that 6 to 7 million is when you have those discussions. But certainly,
so many times
you don't give that up. Right.
Okay, so then let me kind of put a twist on that question, because a lot of companies, in fact, I was working with one again last week, that the retained earnings number is there, right? And retained earnings are basically profits from a previous year that were left in the company, but there's no cash.
Yeah, I've seen that where somebody ends up buying a truck or property, and those are not generally accepted accounting principles.
So
those are bad. That needs to be reconciled, because who owns it?
Right.
Does the business own it? I'm selling the business and I have retained earnings in kind. Who owns that? Well, the business does. And if those are discussions that we have. Is there anything that you're going to keep out of the business? Now, that's kind of a stretch. If somebody buys a cabin or land or something of that nature, that's a little bit of a stretch.
Although I have dealt with that.
I have seen it myself. And boy, that accountant that's some major juggling. I don't know how you can make that happen, because it's really not appropriate. You need to leave the business. We would look at, when we look at balance sheets and we look at just the general health of the business, we're looking at those assets. So we're looking at, do these assets match the liabilities and the equity? Does that it has to equal each other. They have to they have to be balanced, hence the name balance sheet. But we also look at the accounts. I look at the accounts, what's in the accounts. I want to know, like when I'm doing evaluation and we get to that next step where we're actively getting ready, I need to make sure I know everything that's going on. So if there is a situation like that, we can address it before we take the business to market. But yeah, it's very important to account for retained earnings accurately. You can do some QuickBooks fumbling and make things balanced, but that doesn't mean it's really balanced.
Right. So if we have that retained earnings number out there, right, you really need to sit down with your accountant at that point and clean that stuff up.
Absolutely.
And it's better to do
before
that
sale.
Well before you start getting into that piece of the puzzle.
And that's one of those unresolved opportunities that comes up when you're year 5 in a business but not selling for 10 or 12 or 15. Those are one of the things that can come up, and that can save you so much heartburn over the next decade.
Yeah.
I mean, makes life a lot easier when everything's done the way it should be done.
Yeah. And as a general rule, I can look at our retained earnings in the company and we can trace it back to money sitting in an account somewhere or something that we've done because we've kept it in the company. So hopefully we answered that question for you. Just want to jump ahead, right? So one of the things that, and you've referred to it a few times a little bit, right? You mentioned earlier the company that you used to manage was, I think, 11 to 15%, you said,
typically.
Right? I have always used and seen that, again, in my experience, the average net profit before taxes for a company, I always said was 3 to 5%. Well, if we take a little bit larger look at this screen here, right? So this comes right out of that same report. And again, we're going to share this with you literally in just a minute, is the average pre-tax net profit for companies. And so I see in 2020, the average, even in 2019, 4.82%, 4.83% net profit before taxes, right? And then, oh, by the way, Uncle Sam's going to come and get his little piece of it, right? In 2018, 2.6% was the average for companies in this $3 to $5 million range. So this is not what you're shooting for.
Oh,
right? I mean, again, as a company, we talked about it last month, you want to be shooting for a double-digit net profit in your company so that, again, that totally changes the entire look and value of your company.
It does. I mean, think of it in terms of our example earlier where we were looking at, a net profit of 6% at $45,000. Think if you doubled that.
Right.
What's that going to do? Well, it's going to double the valuation.
Yep.
Because the multiple is going to double. So in terms of proper accounting and management, I mean, it really, knowing your numbers pays dividends. I mean, I I can't operate my business without having an intimate knowledge. I look at it every day. I know exactly where money's going in, where money's coming out. It's very important. And when we're looking at the value of a company, that again is where we find those unresolved opportunities. That's where evaluation is so important. If you come into the game and we're doing evaluation because somebody gets sick and has to exit the business, it's very difficult.
Sure.
From a lot of different for a lot of different reasons, but one is there's no time to make corrections.
It is what it is at that point.
It is what it is, and in terms of working with companies, even if we're 3 years out or 2 years out, that's getting pretty short on the timeline, but if we have a little bit of time, we can show 12 months change, 12 months of change that's backed up by specifics. Like if I can qualify those changes and say this is what happened to our P&L, our net profit against revenue, and here we improved it. We went from 4.82 in our example here in 2020 to 10. How did we do it?
And we've been able to hold that month over month.
For 12 months. If we can show that, that's powerful. And if we can do that for more than 12 months, typically if you do something that affects change to that extent, you're going to see that doubling increase and increase. So I wouldn't say it's exponential, but it certainly, if you see a 3% increase and you study and understand why you got there, it's a lot easier to get another % or two out of it.
Sure, right. Because I know what I did to make that happen.
And I have a method and a system for doing it.
Right. So, okay, at this point, and in a minute here, we're going to share this, some of these ratios and stuff for you. But for a minute, if you can, before that, take me through that valuation process, right? So I'm a contractor, I'm a business owner, right? And I'm looking to get a valuation. What does that process look like?
Well, the first step in the process is get your books cleaned up. Make sure that all your I's are dotted and your T's are crossed. Your balance sheet is clean. Your retained earnings is correct. Everything is accurate. Once you have an accurate set of financials, we need 5 years of financials. We do a discovery questionnaire, which really gets into a lot of detail. Because it is proprietary, I don't get into it on the internet. But it's very specific. It's geared towards understanding the whys behind how things are done in the business, and that's as important as anything. The numbers are going to be what the numbers are, but understanding things like, we talk about personality profiling. That's graduate level stuff, but it really puts you at the forefront of managing expectations when it comes to employment. If you're able to do that in this economy and in our current labor market, human capital is one of the most important things that I see with contractors. To a contractor, the most successful ones are the ones that manage that well. If I could tell somebody to do one thing, hire well. If you hire well, a lot of these other things kind of work themselves out. We talked about delegation last month, or a couple of months back. Very important to have the right people involved in the right places in a business. But once we have that 5 years of financials and we have that discovery questionnaire where we seek out all those answers to the questions that a buyer is going to ask, it typically takes about 4 to 5 weeks, and we'll put together some numbers on what our expectations would be. Now, that doesn't necessarily mean that's what we'd go to market with. I've had a situation where the valuation came in at about $3.5 million. Well, the reality is it's more like $5.5 million is where we're going to be taking it to market. And sometimes we don't, if we're taking a business to market, sometimes we don't even put a price on it. Sometimes I let that flush itself out. Because there's sometimes value over and above what we understand there to be value in. If I know the labor market, or if I know the labor market is constrained or limited, for instance, or maybe I have some knowledge on market share, which we develop, and that's part of our process as well. If we have that understanding of where the company is truly positioned in the market, that approach to take that business to market, the market may be more than what I even think. I don't want to have a preconceived expectation on what a business value or our business is worth in the marketplace might be, it might be more than, so in some cases, we let the market dictate the price. You know, we work in a bunch of different sectors, not, you know, one of my colleagues works in the cheese business. They've done that, you know, and you're talking tens of millions of dollars difference potential.
Above where it would have been valued.
What we would have expected to necessarily, but the market, you know, it just depends on the area, the growth, the penetration, ability of somebody to come into a market. You know, what are the barriers to entry, labor pool, all those things.
And when you talk tens of millions, you're not talking about a $2 million company at that
No,
point.
that's
right. But
yeah.
but dramatically above where you thought it would be. So,
Correct.
So this is a good question, right? Greg's asking the question. You know, I'm a seasonal business, so there's times of the year I have a lower profit through August and then more profit in the last quarter. How does that look in the double-digit equation?
Seasonal business.
So
what kind of
and so I can really take that one.
Yeah.
So you know, what we're looking at is what was your year-end net profit, right? Because just about every trade has that seasonality, right? In fact, the company I was working with last was in the pool. Last year was pool industry, and they got like nothing all winter.
Yeah.
Right, and then we go into, you know, it's just getting ready to start kicking off here in a little bit. Year end, Greg, I'd be thrilled with that. Right, so you're double digit at year end.
Excellent.
I'm good. Right, and again, that means that, okay, I may have been at 4, 5, 6% the first part of the year, but then I was at 15, 16 the last part, and so we average out at 11. That's exactly what we're looking for.
Yep.
Right, and so.
And how do my question is, okay, if you're from a business management standpoint, why are you so cyclical, or not cyclical, but yes,
Seasonal.
we're seasonal, but that doesn't necessarily have to be the case. I mean, there are ways to. You're never going to smooth it out. I mean, it's never going to be the same every month over month.
Winter comes every year, right? And summer comes every year.
Absolutely. I mean,
we're so driven by that.
but you have to look at it in terms of what can I do? Are there, if you were able to change that, those down months, if you were, let's say you're operating at break even and you were able to increase that by 5%, what a difference would that make? And you think about that in terms of, you know, the HVAC industry, February and March, what do? We do cleaning checks, right? Everybody does cleaning checks, and we do them again in September, October. And it's pretty usual, typical, but when are you doing your marketing? Are you bringing that marketing? Are you do pre-season sales? There's all kinds of things that, you know, in looking at businesses for sale and having worked in the industry, you know, and Greg, I see you're in the chimney world there.
And so that makes total sense why the first chunk of the year is lower, right? And then we get to the, you know, suddenly the cold weather comes and everybody's looking for checks. And first line or second quarter it leaks.
Third
quarter brick.
Fourth fixing damages and whatnot, probably. But it really depends on the type of business that you're in, and there is seasonality and cyclical flow to almost every business. There are very few outside of even the defense industry, oddly enough, there is a cyclical nature of that. It can be cyclical and seasonal.
So I'll actually throw Greg one in there that we've got one. I was working with a chimney contractor not all that long ago, and he actually started offering incentives for his customers to basically do the inspections, do a lot more inspections, drop the cameras down the chimney and things like that in the spring of the year. Because if we find an issue, we now have all summer to fix this thing before we get to the crunch in fall, when all of a sudden, odds are in fall, when I'm running silly, the price is going up. And so he actually built in incentives to, and that started to even out a little bit of what he was doing there. Good, excellent, appreciate it. So, all right, so let's go into looking and watching our time. So I'm going to flip over real quick. We've got a report, and we're going to share this one with you. Right, so if you guys want to share this document, there's a lot of information in here. Right, so we're going to share it in the chat box. And again, so we're not going to go through all of it. But this is, again, looking at a company. And so, again, if we want to narrow this down a little bit, we can. But this was a company about $3 to $5 million. That's the average. It's not a company. It's the average of all contractors. This one happens to be HVAC. In this part of the world. And so wanted to just zip through a couple of these because there's a ton of solid information in here. Some,
Sure.
they're all important. Let's be clear with that, right?
Yeah.
But there's some that are more critical that you look at and understand
Sure.
on the surface.
Absolutely, and we'll just keep that up there. When we're looking at business revenue, that's obviously the revenue that we bring in. So that's your sales. When we look at cost of sales, that's the cost. We talk about, and Bill and I talk about this from time to time. We talk about things like contribution margin, which is a little spin. Little more graduate level look at, and we can certainly get into that at a different time if anybody wants to talk about it. But cost of sales, when we look at the labor portion, that's one of the variables in our business processes that we have some control over. And that might be, I've said it in the past. I know we joke around about it, but one guy works, two guys talk, three guys party. Sometimes when we're doing, that's where the labor cost of it, or the labor portion, you can break this overall annualized industry ratios. You can break that down to the individual job level. You can say, here's what I sold that furnace for, or here's what I sold that chimney job for, and here was my cost of sales in terms of labor, materials, and you can break it down to that level. And managing those numbers, managing those metrics, I call them, gets you down to your gross margin. When you look at the cost of things, when we take those costs out of revenue minus expenses is our profit. Our gross margin, and then we take out our overhead and things of that nature, our officers' compensation. Oftentimes, if we're really looking at these numbers frequently, we're able to actually put those numbers in to the individual job potentially.
Yep.
Because we know what our overhead would be.
And I do believe, right, so we're going to roll through the first one, right? We've included in here just a whole bunch of, a lot of these terms that we're talking about is, let's actually go through and define them. What do they mean, right? So we've included that information in here in terms of what they are, and in many cases, how do we calculate them? And I think, Glenn, if I remember correctly, and I'm just going to, so we've got the same, really income and expense here, whereas the last table we showed you was actually dollars. This is now getting into the average percentages per company.
Correct.
Right, so your revenue is 100%. I see, cost of labor, 26.76%, right? So we start working down that one. Rent for the average company, 2.19%. Repairs, 0.36%. We start to see, and so that might make it a little bit easier. And how do I apply these numbers to my company?
Exactly. And now understand, again, this is industry average.
Right.
So we don't want to be average. And honestly, and I got to tell you guys, if having run an HVAC company that was very successful, and we did HVAC, we did electrical, we did plumbing for a short time, focusing primarily on the HVAC. The program that Grandy and Associates has in terms of, at the end, we'll talk about that at the end. In terms of the resources that are available for the price, it's a no-brainer to me. Not even from valuing increasing the value of your company, but just increasing your profits. I mean, it just makes sense. These are tried and true principles. I don't think Bill's reinventing the wheel. I mean, these are, the way he does it is unique. It makes it very easy to understand. But these are principles that have been around for a long time. The problem is the translation is very difficult. So, we've included each one of these items by percentage so you can see. But if you pull that screen back up, if you were to look at something like cost of sales, somebody might call it cost of goods or cost of sales percent. What's your cost of goods ratio or your cost of sales ratio? Well, we can see that if we put ratio after cost of sales, that's what your ratio is. Right. It's 25%. It's whatever that item is against revenue. So cost of sales divided by revenue is your ratio.
Yep. And one of the things, again, and Glenn, you made a great point there, is that idea that, remember, that average for the country is 4.8% net profit down
Correct.
here. right? You don't want to be right. So you want your revenues and that side of it to be higher than these percentages, and you want your expenses to be lower than these percentages, right? This is just that average mark, right? So, okay, so let's go through there and jump down a little bit farther, right? Because we've got some other, anything on the balance sheet numbers, Glenn, that we would have them pay attention to.
Well, I certainly watch in terms of the health of a business. I look at what's the current ratio. What are your assets divided by your liabilities? Typically, the higher the number, the better. So I think industry-wise, you're usually around 2.1. Arguably, that can be better. And then we also look at what's called a quick ratio, and that's probably the most meaningful in terms of contractors and as it relates to the balance sheet, and that's your cash and your receivables divided by your liabilities. So it gives you a good barometer on the immediate health. Other things that we look at, what are our accounts payable? What are our accounts receivable? We look at those numbers in terms of days to pay or to get paid. If you're taking longer than, well, ideally, 45 or less is like the magic. I mean, but less than 30, you should be getting paid in less than 30 days.
Absolutely.
And you should be paying likewise in less than 30 days. If you can pay in less than 10 days, you're probably taking advantage of some discounts. You see that little 210 net 30 on the bottom of everybody's invoices. That just means I'm going to give you 2% off the net price, but you're going to have to, or the 2% off. But yeah, I'll give you 2% off if you pay it in 10 days, but you got to pay everything in 30.
Yep, absolutely. So Patrick, just to let you know, I see your question out there. We will get there. We're not ignoring you. So the again, so we run it a little bit farther. We've got balance sheet definitions; those are in there as well. And then we come up with again the percentages; those are in place, just like we did with the P&L. Financial ratios.
Cash flow solvency. These are good. Accounts payable. Again, you'll see the current ratio and the quick ratio there. The bigger, the better. Obviously, the more assets you have, it's always a good thing. Inventory, current liabilities inventory, that's a number to look at too as a percentage of overall revenue, but also as an overall value against cost of goods or cost of sales. That's an important thing to look at.
So on that one, let me ask you that one, because right now a lot of companies they quite frankly would be heavy inventory because they were able to buy it, get their hands on it, because again, inventory is so hard to get.
It is.
And so building up inventories right now so they have the product to sell when things start moving. Is that a problem?
Not necessarily, depending on if you're doing like storefronting or how you're paying for that. Those are discussions, again, more graduate level stuff. If you're doing some type of percentage on a monthly basis, or if you're buying it outright. If you're buying it outright, not probably, I shouldn't say it's not the best idea, but it's going to make your P&L look a little different. Yeah, so you're going to have an explanation as to why you have all this inventory. Yeah. And to be able to offset that inventory with sales, if you can pre-sell inventory, even though if it's not being installed immediately, but if you can pre-sell it, and you're using generally accepted accounting principles and you're on an accrual basis accounting method, it doesn't matter then. Then it's fine. Because that's been sold, you've realized the expense, but you are also going to realize the sale as well.
Right. Okay. Sounds good. So let's, now there's a couple of other, again, there's so much in here, and quite frankly, we pared this thing down a little bit because there was so much in it that, quite frankly, my head starts spinning even looking at it. Until you get a chance to look at it. So here we've got when we start getting into some of these financial ratios, the solvency piece of the puzzle. Again, what you're seeing in these graphs is the average over the last couple of years for companies in this size range. And so I can see where they're at. And then the nice part about this is under each one, it actually tells you what it is, how to calculate it, right? So you mentioned current ratio a little bit ago, right? Underneath I can see it's the current assets divided by my current liabilities. Right, so you can kind of see how you shake out in that area.
And that's just a measure of solvency. Like how healthy am I? It's a basic barometric. If I see that below 1, I'm going, now I know why you're selling.
Yeah, right.
Because you have to. I mean, you're going to be out of business anyway. You might
Sure.
as well. You're selling. It's a fire sale.
How much are you borrowing at that point?
And if I'm a
Keep the
buyer,
company
that's what the first thing I'm looking at is what's my current ratio, what's my quick ratio.
Yeah.
First 2 things a buyer's going to look
and
at.
again, the lower it is, the lower the price goes.
Yeah, absolutely.
Right,
Yeah.
without a doubt.
Or the lower the multiple, depending on what method you're using.
Right. Yep. Absolutely. Right. So that would be certainly a big one. So the current ratio, quick ratio. Okay. Here's the quick ratio on this next page here, page 9. So again, you can see that when the cash plus accounts receivables divided by your liabilities.
I love that one on a monthly basis. I like to look at that. I think that's going to make you, especially if you're a very capital intensive business, and I know we've got to have a bunch of different contractors, but this is going to let you balance some things out as well. So if you do have a situation where you have to pre-buy, and your accountant can help you with this. I am not an accountant. I don't even play one on TV. So, but your accountant can help you come up with a strategy to buy right, and sometimes even pre-buying, but doing what we call like a blanket purchase with releases.
Yep.
That might be more appropriate. I know like the distributors, they all want you to buy a semi-load at a crack. But if you're down there at the distributorship anyway, it might make more sense to realize the cost of that particular good upon receipt instead of, once you have a sale.
Right.
Those are all different strategies that, you could employ, and your accountant would be better at that than I am.
So I do want to hit, because again, just watching what we have, and there's a ton of information. We'll continue going through some of it as we have the opportunity. But the 2 questions that came up, number one is, Doc is asking, how important are the number of service agreements or maintenance agreements that the company has? How important is that when we value the company?
Well, the more you have, the more valuable you are. From that, I guess from that standpoint, not to be flippant about it, but how important are the number of service agreements? I guess if I'm a buyer, in terms of evaluating a company, if I'm a buyer, and I always look at things in terms of when I'm selling a company, what's my buyer going to look at? I'm looking at that number of service agreements as a barometer for the health of the sales program that's built into my employees. Because service agreements, depending on how you do it, I mean, if you have a salesperson that's out there, beating the bushes and getting them one at a time, or getting them in groups, or however you do it, that's one thing. But a lot of times your service agreements are going to come in play when you have a service technician out there and he says, you have a half, we probably can keep this thing running for a few more years, but I think it would be beneficial for you to have a clean and check, or let's get you on a service agreement so that, in the event that we have to replace it, maybe there's a discount, or things of that nature. So there's value in that. It tells me, as a buyer, it tells me the health of the sales process. In terms of other value that it might add, I might look at it and say, what is my what has been done to train these employees, but it also might say, what's the lifetime client value? What's the lifetime customer value? So depending on your model, you might have a model that says we're starting here. When we go there, then we're going to try to sell the indoor air quality. Then we're going to try to get a thermostat, and we're going to build this up. And when we get the service agreement, we've got it. Now this is like an A-plus client, and maybe we segment them separately. So,
or it may go the other way around. We get the service agreement first, and then we get the air cleaner, and then we get the thermostat, right? So those two tie together very tightly.
Absolutely, and again, depending on the individual model of the business, and that's going to tell me as a buyer the health of the company. So I am going to probably look at that. I probably wouldn't look at that initially. That might be an aside question. If I have a question, again, we talked about earlier, I see something that looks like a red flag. Well, now I probe a little bit. So if I see that your service department is lacking, that might be my next question: is how many service agreements do you have? Or I see you're doing a lot of new commercial construction. How many service agreements do you have with those existing clients, and how long have you had them? And there's all kinds of different scenarios that can play out in the mind of a buyer, and we try to get inside that buyer's head very quickly, and that's what we're good at, is really understanding the motivations, the purpose, motivation, and direction that questions are going to come from a buyer. That's our role.
Yep. Okay, good. So that, yeah, and again, in a nutshell, it was the more you have,
Absolutely.
there's always value to them, without a question of a doubt. So Patrick had asked him the question, during this process, I'd like to keep my building and lease it back to the new owner for a revenue stream, after the sale. Is that a problem?
That's a loaded question. It can be, depending on the building, I guess. I'd say if the building's in good repair and it's in an area where what we call a cap rate is high and you can do that, it might be very advantageous. But again, that's going to depend. It's generally not problematic unless there's a problem with the building. Case in point, I have a company that's they have a refrigerated warehouse. They're looking to that they lease. When they leave, the cost of maintenance for that existing owner is going to be very expensive. Just going into, and Greg just asked this, the cap rate, that's the rate at which by percentage somebody would receive money back on the money they invest in a building. And that might be something we can go over in a future episode too, just that would be a kind of a next level kind of thing. But I would say it's probably, the short answer is probably not problematic, but it has to be addressed. And again, it depends on the buyer and the appetite for owning real estate. Like around here, buyers want real estate with the business asset. I have a situation right now. I'm working with a company, and they're a distributor for weights and measures devices, and they have multiple locations, and they work all over the country, and they want to keep the real estate because they want that passive income. They want that advantage of having that passive income. Depending on your age too, that's another consideration. You have to do, I do a net present value analysis with my clients that want to go that route to say, here's what you would get up front, here's what you would get over the course of 10 years. And when you're 65, sounds like a great idea. When you're 75, it does not sound like a great idea because it becomes increasingly burdensome the older you get. Now, if you have a management company that's handling everything for you, we do some work in that regard where we can, assist with leasing and things of that nature. So it does happen. It does happen where we would assist. One of my colleagues sold a large warehousing operation, and they didn't need the whole thing. So he found leasees for the remaining portion, and we managed that. And so
really the question on that one. Now, within your company, right? I mean, while you're still there, it makes sense while you're there for you to own the building personally and have the company pay you rent back.
Correct.
Right? Because there's no a federal state income tax on that. Right. I'm sorry, Social Security, and you don't pay that on that portion of the revenue that you take out of it. But once you sell, I think a large part of it also, like you said, depends on that buyer as well. Yeah. Do they want that real estate? And I agree, in this market that we're in, that's kind of a big deal.
Like it, but you also have to balance that out. Is there an adaptive use component to your building where it could be leased out to somebody in a different industry? Is it big enough where you could bring a manufacturer in? Is it flexible enough that you could expand offices and do an office building or retail or location? All those things have to be considered.
Well, and I have to think there also is, unless you get a commitment for a long-term lease from the new buyer,
right?
At 70 years old, do you want to be looking for a new tenant in this building that has been an HVAC company forever, right? So those are the decisions that you have to make as you go through that.
Well, and if you're, we look at generationally transfer of businesses, we see a large failure rate. Now, we've talked about that, and I think when you're going down the path with Grandy and Associates, you mitigate that to a large extent. But in general, if you're leasing it out to somebody, you really have to know who's leasing from you, because what happens if they leave? What if they just become insolvent and they're gone? Can you rent this out? Well, that's part of that analysis that we do on the front side. I hope that helped. I didn't want to get too far in the weeds on that one, but
so again, watching our time, acutely aware of that. Glenn, I have to ask the question because they're thinking it, they're just not typing it, right? And what is this going to cost me?
These are typically we're between $2,500 and $7,500. It depends on the depth of whether we do a pricing report or a full-blown valuation. In most cases, if your business is under $5 million, you're looking at a $2,500 to $4,500 is typical. Again, it's kind of catered to, depending on the number of methods that we utilize on a pricing report. Generally, I use at least 3. We'll use a income approach, kind of like we talked about here. We'll use maybe a multiple of discretionary earnings. We'll use buyer's test method, which basically says here's how much a business could be purchased. This is how much would be borrowed to purchase a business of this size.
And just to clarify that, to make sure you caught that, they're not doing one valuation. They're typically valuing the company
several different
ways
Correct.
To make sure that there's
Correct.
not one that's giving us an anomaly.
Right, and when you're looking at and then we look at the market approach as well, and that's I use the market approach. I look at that. If we have a very basic, 1 million or less business, I might do a very a less expensive pricing report, just because I probably can do that on a some of those small businesses you can almost do on the back of a napkin in a lot of cases. Just because there isn't a lot of market impact on those.
Sure.
But typically 2,500 to 4,500 is typical.
And one of the things that I would recommend to you is, right, so one of the things I like about, Glenn and what they do is when they do a valuation, that valuation report is given to the client at that point.
Yeah, that's yours to keep, whether
Right.
you work with us or not.
Right, where there is a lot of companies that say, okay, well, we'll give you a one sheet, but we're not giving you all the detail unless you want to start engaging and let us sell your business, and you might not be there yet.
Yeah.
Right. So
and I'm doing just fine, and if I don't take somebody's business to market, that's just fine. I mean, my goal is, at the end of the day, I want to help people. I love the industry. I have a lot in common with the people that are in the contracting world, because I've been a contractor. I grew up in the business. My dad was a general contractor. I've owned a general contracting firm. I've GM'd and managed HVAC firms. I've owned an HVAC firm. Worked in the electrical arena. So I understand it. I understand what people go through. As a core group of individuals, those are good people.
Yeah.
Those are the people I surround myself with. And with that, we don't always get the opportunity to sell. I mean, we're working on a few assignments right now where it's just we've got a family member that wants to take the business over, but we want to be fair to ourselves and fair to them. What's this business valued at? What's this, we need to be fair. And that doesn't mean that's what it has to sell at either. You can, if I give you a value of $2 million on your business and, your son or daughter wants to buy it, you can sell it to them for $100. It doesn't matter, but at least you have a barometer to say, hey, this is what the market kind of expectation minimum would be for the business. So at least you have somewhere to start.
Excellent. All right, so we do have, again, the report that you've got has a lot more information in it. Know that it's there, but you really ultimately need to look at, it comes back to the same 2 action items that we talked about last month. Is your business healthy enough to meet your timeline in that succession plan? And is the business financial model sustainable for your exit and the business success? Both of those answered properly increases the value of the company.
Every time.
Every time. Right, so really comes back to those 2 items. So again, one of the questions that we get all the time is how do I find out, learn how to do some of these things? Again, the next chapter is brought to you by Contractor Academy. Again, the ability to get training for your team on your time. Again, you can go to the website, literally subscribe for as little as $29 a month. If you have more people, the price goes down at that point in time. But once you do that, you have access to every program, every hour of training. Right now, I think there's we put around 2 more programs up this week. It's something like 56 hours of training inside there as you jump in. Again, it's not only we have business type topics, but then there's also understanding the business, helping my team understand the business. And then also getting in, and we've, because of request, asked have a couple of technical items out there as well. So those items are all in place. If you want to buy for your team, 3 different levels that you can subscribe at. You can find all of that at grandyassociates.com. So, Glenn, I know, right, based on last several programs that we've done, there's going to be questions for you coming up down the road.
Absolutely. Feel free to reach me at gherman@cbs-global.com, or you can reach me at 262-719-2270. That's my personal cell, so you can feel free to call that as well if you have any questions, or if you feel like I didn't answer one of your questions, feel free to give me a shout.
Absolutely, and again, so we've been recording this thing as we do in the past. It's been live streaming on both Facebook and our YouTube channel. Those are available. You can actually, as soon as we're done, probably go out there and find those. But we will be sending out an email to all of you with the link for that as well. As soon as we get it finalized in there, we'll also include Glenn's information on that email as well as a link to the Contractor Academy. If you need help to understand really the number side of your business, our Planning for Profit pricing platform is the way to go with that one. And so, again, easy to get into it, really easy to really find out what you need to charge per hour to make sure that you hit your profit targets and hit that double-digit net profit. With that, again, appreciate the questions that you guys asked. It's always actually makes it more enjoyable to have the questions there and be able to respond to them. Again, by all means, if you have any more, reach out to us, let us know those. With that, we'll bring this episode of The Next Chapter to a close.